But the problem when it comes to investing, it's a bit impulsive decision. So that is where the challenge is. If the investors start taking that as seriously as they when they are going to buy their new mobile phone, checking all the features, understanding the price, the best price available on whether it's Amazon or Flipkart or the next door store out there. So all of that is a function of how much time and how much effort that one puts in.
The retail investor is kind of having that question mark in his mind. What should I do? Should I see gold as an investment portfolio in my bucket? Or should I be buying more? Should I be selling now?
Now, let me tell you this that in the last 5 years, I used to own HDFC Bank, but I was significantly underweight. I never owned it more than 5%. It is only in the last 18 months that I doubled my weight from 5% to 10%. And if you would have realized in the last 18 months, HDFC Bank has actually outperformed.
There's a tailwind, yes.
Right? Now, why did I do that?
Hello and welcome. My name is Narender Agarwal, and we welcome you to this platform of returns and beyond of Wealth One, where we get the best of the brains who are working in the financial markets, specifically for PMS and AIF. So today we have a guest who has an illustrious career. His name is Mr. Sachin Shah, who is the fund manager of Emkay Capital Builder Fund. Have been into this as a fund manager for last 12 years, managing 850 crores and upwards as AUM. Has an illustrious knowledge about the financial markets, seen the different trends, seen the different cycles, and today he's here to share a lot of insights with you all. So sit back and enjoy, and this is going to be a great roller coaster ride, a great learning, and a great interaction for all of us to witness. So welcome, Sachin, to the show, and we're so glad, and thank you so much for taking out time for our investors.
Thank you, Naren. Pleasure is all mine. Thank you so much.
All right. So can we just get started with our questions? Is that?
Sure. Shoot.
Okay. So you have been always talking about that as an investor, you should always not be chasing momentum. Okay, there has to be conviction in compounding. So how does that work, and what is it that the investor who sees so much of noise happening in the market outside with so many things happening at the same time? So how does he keep not distracted and stay at his conviction and stay for that compounding era that you are talking about?
Yeah, sure. So, Naren, let me just set the context, right? And then we'll come directly to how we are actually doing things, right? So, why long-term investing? Why not just do short-term? Why not do day trading? Why not do very momentum and all of that you mentioned? I mean, you can give multiple names to all of this, but why buy and hold? Why just do long-term investing? The reason of doing that is because when the whole fun of investing in equities as an asset class is actually the game of compounding, right? And like Einstein said that the eighth wonder of the world is compounding, right? And the people who don't understand it, they'll pay for it, and people who understand it will earn it, right? So if you really want the compounding to play out, you need to own those businesses for a longer period of time, right? Because if you keep on buying and selling, then your underlyings are just getting, you're cutting them in the middle in the whole business cycle, right? And I think another very important thing is that it's impossible to see future 5, 7, 10 years, so much because there are so many dynamic moving parts. So it's all about betting on the right management, uh, making a calculated bet in terms of the business direction, because you don't know when will that direction catch momentum in terms on the business side, and when will it actually capitalize for you as an investor in it. It's impossible for most of the people to figure that out. And we have seen so many times, right? Like, for example, if you take some of the the best compounders in this country, and there are probably few hundreds of them. Okay, over the last two
So
decades.
if you can name some
Yeah, say
who
if
are
you
the
say if you
whom
say
you feel is the best
say like
compounder.
HDFC Bank, say Asian Paint, say like Pidilite, right? At some point in time, there used to be a company like Gujarat Ambuja, which did fantastic, right? I mean, you look at some of these pharma companies, Sun Pharma, right? The wealth that companies have created is enormous, right? Now, when you see all of this actually playing out, what are the, and when you see these returns, right, like if they have done some 20 times, 30 times, right? A good part of that return has come not in those 20 years every year. It's not like a bank FD that every year you get a fixed 20%. It's like it
Correct.
gives you you know, it's bunched up in a few periods. Now, which period, how would you know? So what are you actually trying to do? You're just saying that you understand that this business has a very nice opportunity. Say for example, IT offshore services. In the late 90s, early 2000, uh, it was less than a probably $10 billion industry. Today it's $250 billion industry, right? And a handful of only 10 companies have been able to actually capitalize that. When I say capital, means they are in that $1 billion profit pool, right? Just 10 of them, or maybe less than 10 actually, right? Now, the whole point is that if you could understand that whether it's Infosys, whether it's HCL Tech, whether it's Wipro, whether it is Cognizant, these are the right managements. And they also had this understanding, they had this vision, they could see this big picture, right? And that is where their entire strategy, their execution was all towards it. As you see that happening, you know that these are the guys who are going to capitalize, and this is where the compounding is just going to happen. When, it's impossible to figure that out. But as long as you know these are the right people and the business is in the right direction, I think it makes life much more easier. So the whole fun of investing in equities as an asset class, like, because see the whole thing is, when you say in fixed income, I'll make say about 9%, 8% compounded over say 10 years, 15 years. In equities, if you just take at the benchmark level, just Nifty, it's about 12%. It's not like some 2x, 3x of the fixed income. It's probably about 1.5x. Okay. But the 2 3% on a 15-year is a huge multiplier effect. That's what the compounding
That's what the
does.
compounding is all
Right?
about.
So that is why, you know, we have chosen this path, that we want, when our investors are investing with us, their hard-earned money, and this is their savings, and this is not that this is something that this is their something what they're dependent on as an income. They already have income streams, but this is their savings, and this is something what they want to grow over the next 5, 10, 15, 20 years. And we actually have investors who have been with us for more than now 15 years, literally, right? So in fact,
Because
that's
they kind of believe in what you have done and what you have delivered. So there's a lot of conviction that comes in. But what
yes.
happens to the newer investor that comes in? Will he have the patience to wait for that long to have that conviction or that trust build up with you?
Right. So that's a very critical thing, you know, because see, it's in my personal experience, particularly with our direct investors, right? So we have two channels. One is direct and one is indirect. Indirect is generally coming through the wealth managers, and direct is guys who know us personally and they directly approach us, right? Now, when it comes to direct investors, I have a first-hand experience for more than 20 years now, right? So what happens there? It's all about having the right communication at the beginning, before the investor is actually invested with you, right? Because as long as you are avoiding any kind of mis-selling, as long as you are avoiding any kind of selling a dream, I don't think there is a challenge. As long as you are very clear in your communication with the investors that what is the return expectation they should have, what is the risk appetite they need to have, and what is the investment horizon that they need to have. If you have communicated this, in spite of this, but first is this, right? This is the foundation. The next step is, over the next 12 months, 18 months, the portfolios underperform, markets don't do anything. And you know, investors wonder that there's so much of opportunity cost compared to a fixed income, right? Or sometimes even in another equity fund, right? So how do you manage this? That's your key question,
Yes,
right?
absolutely,
So
yes.
I'm just thinking, I'm just telling you that the way we do it is that first we are into PMS and AIF. So we have the portfolios. We have direct the portfolios are in every individual client's demat account, so they can actually see what is their underlyings, right? When they see those underlyings and when they understand the quality of each of those businesses, so we take that effort, okay, to explain them each of those businesses in our quarterly newsletters. Whenever we interact them with them on a personal basis, one to one, or whenever we have a one to many kind of conference calls and those kind of things, so it is all about communication. But the best part, and that is the most satisfying thing for me, once we cross this 3 years, the stickiness of the investors with us is so high. So, I say this internally that we are very lucky that we don't only have longevity in our portfolio, so the vintage, but we also have a great vintage with our investors. And we have a great vintage with our team, our investment team. So my investment team is now almost 10 years plus, which is not so easy in our industry because the churns are very high. The portfolio churns are also very high, right? I mean, and investor churn is, I mean, even if you see mutual funds, the investor churns are very high there. Our investor churn, particularly on the direct client side, is extremely low. In fact, it's I think less than probably 5-10%. Similarly, our portfolio churn is about under 10-12% over the last 12. I mean, it's about less than 15%. And I think my team churn is almost less than again 10%. So we have this fantastic formula, touchwood, I would say, thanks to the Almighty, which is really working for us.
So when I was studying MK's portfolio and preparing for the podcast and questions, I said, I think the whole podcast will go with only one question, that is holding on for 10 years. That's
Yeah.
something that
So
is
yeah.
that's something that is unheard of in
See, it is. I'll tell you what. See, if you see the current portfolio of MK Capital Builder, the construct, the top 40% of the portfolio is now 10 years plus vintage,
10
which
years
means
plus.
most of them are actually 11, 12 years
So
now.
I'll just stop you here. I want
Yeah.
I want to have a very
Yeah.
quick understanding on this. Okay, so when we say 10 years plus portfolio,
Yeah.
it's HDFC,
Yes.
ICICI,
Yes.
Davis, Mahindra Resorts,
Yes.
for that matter.
Yes.
Yeah. So what is the kind of temperament that you have?
Yes.
When we see the market cycles,
Right.
market cycles is 2 years to 4 years.
Right.
Every 2 years, 4 years, we see
Yes.
a new sector emerging as a leader.
Right.
We see within that sector, we see different companies emerging as leaders who kind of drive the bull run.
Right.
Yeah. So within the 10 years, if I talk of 2015 to 2025,
Right.
we have seen a cycle of 3 bull runs.
Right.
Yeah. So how do you kind of restrain yourself
Right.
from not switching on to those market leaders?
Right.
Is what kind of a temperament does that take?
No, that's a very valid question. So see, the way I think about it is, see, as I was saying that I took over this portfolio precisely on 1st April 2013. So we'll complete 13 years in this March. We're already down 12 and a half years now. And I can promise you it's not been a one-way ride. We've had our shares of ups and downs, right? But so if you see the current portfolio construct, as I was mentioning, uh, the top 70% is now 7 to 10 years of vintage. In fact, I would say 7 to 12 years of vintage, right? So 70% of the portfolio, I've been owning it for a fairly long period of time. But also important is the balance 25-30% of the portfolio, there has been some churn, right? And over 12 years. So annual churn is very low, but still there is some churn. And I will just come that to in a bit that in terms of how some of the new age businesses have also entered our portfolio in the last 3 years. Okay. But just park that question for a minute and to first answer how to manage this 70%, because that's the elephant in the room, right? So you're absolutely right. It's all about temperament and it's about discipline. Just two things. And in fact, I keep on telling my team, right? In today's day and age of AI, right? Everything can get disrupted, but your temperament and your discipline will be your biggest weapons, right? And let me just give you a little bit of an example to this.
And I believe, just interrupting you here, is that this temperament and discipline is something that most of the investors lack in today's
See,
world.
it depends. It depends. See, everybody has to train themselves, right? So, just to answer your that specific question, because an investor, when you go to buy a refrigerator or a television, you're very disciplined about it. You do all the research. You see what measurement will suit your living room. You know what measurement will suit the space for your refrigerator. How many liters you need. You need 2 door, 4 door. Everything is done, right? But the problem when it comes to investing, it's a bit impulsive decision. So that is where the challenge is. If the investors start taking that as seriously as they when they are going to buy their new mobile phone, checking all the features, understanding the price, the best price available on whether it's Amazon or Flipkart or the next door store out there. So all of that is a function of how much time and how much effort that one puts in, right? But again, important thing is that this temperament and discipline is also a function of a lot of research that you've done, a lot of homework that you've done, right? Now, one is that you have to do homework, you have to do research. But in what direction you're doing research also plays an important role in creating this temperament and discipline, right? So, for example, if we want to do long term investing, right, there are two pertinent things. You can't compromise there because all the compounders that I mentioned earlier, the common trait out there is management quality and business quality. If any one of them is compromised, there is no question of compounding happening. Absolutely no question of compounding happening, right? So we said, let us first set our processes in place. And this is what we did 13 years back when I joined MK. In fact, 14 years back. So we said that business quality is very relatively easily measurable, right? You look at the financial statements. But within financial statements, what we said is that instead of starting with P&L, which is where most of the people start with, we will start with cash flows. Then we will actually go to balance sheet. And third, we will go to P&L. The reason is that it's very difficult to manipulate cash flows. There are a few exceptions, but those are truly outliers, right? As far as cash flows are concerned, and if you take a cumulative of 3 to 5 years of cash flows, it's almost impossible to manipulate that. So cash flow is sanctity to ours, right? So first is cash flow, which gives us a good sense of the business strength, how the business has been conducted over these few years and all of that. Then is balance sheet. Why balance sheet is very important? Because every business goes through a good and a bad cycle. You can't escape that. But how did the management maneuver the business during the bad cycle is reflected in the balance sheet, because balance sheet is a cumulative of all these years. It's not a 1 year thing, right? So balance sheet is very critical. Your misallocation of capital, right allocation of capital, all of that gets reflected over there. So numbers have to speak to us. And then of course P&L to understand the competitive landscape, the competitive strength, because if you just do the common size statements and if you see what's the pricing power, what's the cost efficiency and all of that, it becomes very clear. So business quality is relatively easy to measure in a more objective way. When it comes to management quality, now that's a bit of a subjective thing, right? Because it's like two people. I and my head of research would go and meet a management. Management will talk everything that is music to our ears, right? And thanks to Infosys, over the last 2 decades, all the managements have learned what the investing community wants to listen to, right? Because I remember going to the Infosys analyst meet in the year 2000 and the way they used to present was fantastic. But I think everybody has learned that now, right? So after we come out of the meeting and I will say, wow, great management, they have great plans and all of that. And my head of research will say all bullshit. So there is a subjectivity out there, right, between two of us, because we are making a judgment. Let me put it. So we said, fine, in every decision, there will be a last leg where you will have to take that leap of faith. You'll have to make some judgment, right? But before making that judgment, can we have enough data to objectively say that it makes sense to make a judgment? Because sometimes the data itself tells you there's no need to make any judgment, right? So we created our proprietary module called Equal. This is one of its kind module where we evaluate management on a qualitative parameters. So when I say qualitative parameters, all this, all the data points that we capture are in the public domain, right? So there's an apple to apple comparison across all companies. First, second, none of these data points are actually kind of covered in the cash flow or P&L and annual statement. So these are all softer issues. So for example, when I say management quality, we said let's evaluate management quality on five big parameters: management integrity, management capability, wealth distribution to minority shareholders, investor communication, and liquidity. Right? These are five big. Now, each of this is again evaluated very objectively with publicly available data points. So, for example, say management integrity. So, what we are saying to say here is what is the intent of the management towards the minority shareholders? And again, the thought process here, investing is actually a game of probability. There is no 1 plus 1 2 here. Like in life, there is no 1 plus 1 2. Even in investing, there is no 1 plus 1 2. Right? It's just a probability. But in investing, it's not about hitting a six. It's just about avoiding mistakes. Right? So here we are going to reduce our probability of going wrong. Right? So we said, okay, higher the skin in the game, lower the probability that the management will do something silly. So particularly mid cap and small cap companies, right? So if you say a company like, any company where you say promoter shareholding, where today maximum allowed is 75% in a public limited company. So wherever promoter shareholding is 70% or above, we'll give them full marks. So we have 5 gradings over there. Wherever it's below 30%, we'll not give them any marks for that parameter. If it's between 30 to 50, we'll give them 25%. If it's between 50 to 70, we'll give them 50%, right? Like that, we will have grading. I mean, if you see some examples, if you go back to history, in the heydays of IT, there used to be a company called DSQ Software. It was a 4-digit stock. No, it used to be the darling of the investors, the retail investors, the so-called. And in the bull market, the stock just kept on going up, going up, going up. And as soon as the first 3 or 6 months of the bear market, you realize that the promoter holding has gone down to as low as 2-3%, 4%, 5%. So promoter was just continuously selling in the market.
And he's taking his money and going back home. Yeah?
Whatever, yeah. And the companies have vanished.
Yeah.
And there are so many companies like that, right? I can name a dozen of them, at least. Maybe there are a few hundreds, which were 4-digit, 5-digit stocks. Pentagon, Penta Software, Global Tele, how many of them? And they all have just completely vanished. I mean, serious destruction of minority shareholders wealth, right? So one is promoter shareholding. Has it been increasing or decreasing it over the last 2 years? Promoter shareholding pledged. We have seen from the days of Satyam to as recent as some of the large media companies, where we have seen that wherever promoter shareholding pledge is disproportionately higher. And when I say disproportionately higher, I'm saying more than 60-70% of their holding is pledged. They have compromised minority shareholders' interest, right? So again, circling to that main thing, that avoid mistakes. Just keep on avoiding mistakes, right? So this whole equal module is around that, right? So we created these two things where we said that first, we will not compromise on quality, both the qualities, business quality and the management quality. Now, once you've done this, you know that you are with quality, but that doesn't mean that there will be no bad cycles. Bad cycles is going to happen, whether you like it or not. That's the reality.
No, but I have one question here. That okay, fine. You have filtered out the good qualities with the bad quality companies, and now this is your bucket. But how do you identify a compounder from here?
Exactly. So I was just coming to that, right? This is now the next level of research, right? Because then what we are always looking for is growth, right? And we want to look for quality growth. But generally, we have seen that wherever there is business quality, the growth will always be quality growth. So obviously, you try to look for some of the tailwinds in the businesses, right? So we were just mentioning about DV's Lab, right? So we've been owning that stock for now 12 and a half years. And I can promise you in this 12 and a half years, there have been at least twice or actually thrice where we've seen sharp price corrections of almost 25-30% along with business challenges, right? But what happens is that when we would have invested in 2013 first time, we would have already done research on that business for at least 2 to 3 years. In fact, there are so many businesses where we would have done research for 5, 7, 10 years, right? And after that, we got an opportunity to invest because a lot of times good businesses are not available at reasonable valuations, right? So I always tell my team in investing, it's not about being patient only after investing, but also before investing. You know, if whenever if you go for some of these safaris and wherever you see, or even if you see on National Geographic, whenever tiger has to actually go and make a kill, they wait for hours and hours. They wait for sometimes days because they have limited power and they have to ensure that in whenever they use that power, the success ratio is very high. Similar to us, our investors have limited funds with us. We have to ensure that our success ratios are high, right? So first is quality, but then what happens is that because we've done so much of research on that business, so like before invested in DV's lab, we would have met the management at least 2, 3 times in their annual general meeting, in their quarterly con calls, or whatever, or in some of their interviews and all of those kind of, and plus the annual reports, research, and everything has been done, right? Now you are invested in 2013. You keep on continue to keep on doing your research every year, quarter after quarter, year after year, right? Now in 2016 or I think 2017, they had the US FDA problem.
And the crash came in.
And the crash came by almost 30% or maybe 35 to 40%. Stock went down in less than 1 month or maybe 2 months, right? So US FDA challenge, obviously there is an uncertainty about the business, where will it go, what will happen, what not. And the annual general meeting was just around the corner. So like every year, we again went to the annual general meeting. And obviously in that Q&A, we asked the management that this has happened. What do you think? And now this is where the research of so many years comes into play. Because whenever things are bad, most of the times management will always defend themselves, right? But here you know that when Dr. Murli Devi speaks, he doesn't speak any loose language. If he speaks, he means it. First of all, he doesn't speak much. But if he speaks, then you have to just grab it and take it on face value because it's your experience of so many years on understanding this person, on understanding this management, right? So he told us that, I mean, not only me, he told all the investors who were present at the annual general meeting that, see, we were the last ones to get into this problem, but we will be the first ones to get out of it because of two reasons. First, whatever US FDA has mentioned, we believe it's not a big deal. And I'm burning midnight oil at the factories and I will get this sorted very quickly. Second, and more important, he said that our customers, the global customers, the Pfizers and the Abbotts of the world, they have already told US FDA that we are, our quality checks, our due diligence are far more stringent than yours. And we are more than satisfied with DV's labs quality and there is no hanky-panky happening here. So please get this sorted. Please get them out of your alerts and import alerts and whatever you've done because they have 60-70% market share of the products that they're supplying to US. So if something goes wrong here, if you stop them, there will be shortages in US, then don't blame us. Now, when he says something like this, what more do you, and you anyways know that they definitely have a 60-70% market share. And you can't create alternate supply chains so easily overnight, right?
Fair enough.
So now when this happened, I thought, and there were so many people out there, all investors, so I thought tomorrow the stock will bounce back. And I was actually thinking maybe when he said that this is an opportunity to actually double up my stake.
Yeah.
I said, now the stock will go up. How will I buy? But somehow the market gives you opportunity. The next day stock was down 3 to 5%. And I couldn't believe it. But I said, just lap it up. That is where your research, your conviction of so many years all comes into play on that one single moment. I don't know if I answered your question, but
perfectly well, Sachin. I'm sure that what our viewers will kind of get is what is equal and how do you actually get the right business and the right management thing that you've explained so nicely as to how we see the cash flows, the balance sheets, the P&L, and what exactly to see in it. I believe that this is going to be a lot more informative for for everyone who's watching this podcast. Thank you so much for this insight. But now I want to shift gears to the macro level. What's happening in the global economy, and whatever is happening there, how is it playing on your mind? So my first question is the hot favorite question for everyone today, and that's gold and silver. It has played crazily well in the last couple of months, and the kind of geopolitical uncertainty is adding fuel to how gold and silver is playing. The kind of equities uncertainty, the way US is reacting to a lot of countries, how Trump is making a lot of statements, is also adding a lot of fuel to the gold and silver, of course. And now the investor, okay, which I will talk about the retail investor, because that's the biggest chunk that we have in our financial markets. The retail investor is kind of having that question mark in his mind. What should I do? How should I see gold as an investment portfolio in my bucket, or should I be buying more? Should I be selling now? So how we want to understand, how does the fund manager, Sachin, who has a history of research, how do you see this whole thing playing out?
Yeah. So see, two things here, right? Professionally, we just do one. At least I do just one thing, which is listed Indian equities. Okay. So professionally, we really wouldn't have any. I would say a call on the other asset classes, right? But the fact remains. I mean, this is my personal thoughts, that the fact remains that asset allocation is a very important part, right? For every individual, every family office, every institution, I would say, asset allocation is very critical. Whether it is equities, whether it is fixed income, whether it is precious metals, all of it, right? And also, like I mentioned, that every businesses have a cycle, good and a bad cycle. Whether I like it or not, the reality of life is that every asset classes also have cycles, right? I mean, for whatever reasons, there can be, you can keep on giving hajar causes and consequences. But the fact is that there are good times for equities and bad times for equities. There are good times for precious metals and bad times for precious metals, and similarly for fixed income, right? So I think asset allocation is very an important part for any individual to actually apply. I mean, to give enough, I would say, mind share, wallet share to that part, right? So at personal level, for me also, I do that. Okay. And the way I think about it is from a global perspective at this point in time. It's clearly for the last, at least now, I would say 3 or 4 years, at least, yeah, nearly 3 years. There has been this globally. There has been this worry on dollar, right? Because see, one is that they have abused the reserve currency in a way, relatively, right? Uh, because when you see 2007, 8, 9, then you see during the COVID, and then of course, even recently the way they were. I mean, when Russia got sanctions and some of their assets got seized, so all of those challenges. So the actions, if you see over the last at least 2 years now, if not longer. And because why I say 2 years, because in these 2 years, those actions are accelerated, right? All the central banks, I mean, not all, but many of the central banks have been increasing their gold reserve significantly, right? And this has been data in public domain quarter after quarter. So there was clearly a trend from the central bankers, each country's central bank, right, including Reserve Bank of India, they have been increasing their gold reserves and
And
reducing their
similar
dollar
thing is happening
reserves.
with China. China is increasing their gold
China has
reserves
been also pulling out big time
there is
from
no
the
tomorrow.
US Treasury. They
Yeah.
pulled out nearly $1 trillion, $1 trillion pulled out from US Treasury. And they have invested across asset classes, right? I think the trend from central banks has now gone to individual balance sheets. People like you and me. Everybody has started wondering that, boss, if I have so much of currency and if currency is going to depreciate so badly, because if you see US dollar in this calendar year itself has depreciated by good anywhere between 10 to 20% against euro and pounds and some of those other currencies, the Western currencies, right? So
And
it's
why
a
we are not able to see that is because INR is depreciating even faster.
that's a different story, and I think there are other equations which are playing out there. But I think the way to look at dollar is not against INR. It's the
It's
other.
against
It's
euros.
it's those seven
Yeah,
currencies out there. Whether
absolutely,
it's the
yes.
Swiss franc, whether it's your euro, whether it's your British pound, and I would say even some of these precious metals, right? Because if gold has gone up by 50%, your purchasing power of dollar is down by 50% for gold, right? Because if you see some of these large Middle East countries who are really cash rich, all their currencies are pegged to dollar, and they are now very very upset because if you're pegged to dollar and your purchasing power just keeps on reducing when you are traveling to Europe or when you want to buy gold, it's difficult to, and these are very large money, right? So what I'm trying to tell you is that the whole challenge is that now probably the emperor is naked as far as dollar is concerned. And when this kind of trend emerges, how long will this, because the dollar reserves are so large, even a small percentage of that converting into some of these metals, precious metals, I don't think there is, and it's not only about converting some small percentage, but all of that wants to convert as of today. So when you have so much of force and with such large quantum, so it's like force and weight together, you can imagine what happens. That's what's happening.
So I want to understand, according to you, so US is fighting with inflation, US is also fighting with growth, is also fighting with his dollar getting weakening. So what do you see in next 6 months, 1 year? Will US be able to play out of it and come out of it, or this is going to kind of deteriorate from here?
See, see, as we see, it's all about their purchasing power going down. That's all. No country ever goes bankrupt. Why does Indian rupee also depreciate? We can never go bankrupt. As a country, will never go, but just our rupee keeps on depreciating. So it's our purchasing power that keeps on reducing, right? Also, we have to understand. See, if you think about it, there's a one very classic question that comes up that if dollar is there's so much negative on US, why is the US equity markets going up?
It's on an all-time high.
Right? Why? I think the answer lies there. See, it's not about a problem with US economy. It's about the currency. The value that currency has been holding on to, there is a challenge. Now, when you want to get out of that currency, and when you say currency, a large part of that money is in fixed income, the US treasuries, right? So if the rupee, if the currency depreciates there, anyways, your value keeps on going down. And because it's depreciating, you don't get more money. So your interest rates will keep on remaining higher relatively. So you have a double whammy there. So what are those guys doing there? The guy, whoever has money in US treasury, they have the option of taking that money out, putting into some another currency, some another asset class, or getting into US equities itself. Because businesses will at least preserve the purchasing power. See, whenever there's an inflation, businesses tend to actually gain better, right? Because they are actually the beneficiaries of the inflationary environment. So if you are an owner of a business, you will at least protect yourself from the deflation of currency or depreciation of currency and a high inflation in that country.
So point
So
taken
money is
about
actually moving out of fixed income, going into equities as an asset class, whether it's US. Like if you see Germany is doing fantastic. I mean, German economy is not growing, but money is just moving there. So because there's so much money there that a small trickle everywhere itself is a very big thing.
Fair enough. I can understand your point of view on the way U.S. economy is working, but I want to understand this from the U.S.-India relation. So this one deal that is stuck, that is the India-U.S. trade deal, and now there is a lot of pressure on Trump. I believe by the time the this podcast will be released, the Supreme Court, U.S. Supreme Court ruling on Trump's tariffs will also be there by 5th November. Yeah, so how do you see the India-US trade deal, and how is it this going to affect the our equity markets.
See,
Is there going to be a
I think it's an important deal for us because if you think about it, there are at least 7 or 8 industries where companies, Indian sectors have demonstrated that they have the right to win in the export markets, right? I'm just setting the context to answer your question because if you think about it, uh, there has been a trend of creating alternate supply chains from China, basically. And this has been a trend for the last many years, almost a decade, right?
yeah?
And I'm very, it's very painful to say, but I think India has missed the bus couple of times. We've lost a lot of business to Vietnam's, Indonesia's, and the Thailands of the world, right? But in the last 4 or 5 years, since 2019 at least, I would say, or maybe a little before, I think this time the government, the industry, all of them are very clear that we have to seize this opportunity. This time, we can't miss it. We can't miss the bus. And particularly post COVID, this trend of creating global alternate supply chains is accelerating, right? The global purchase managers are very clear they want to de-risk themselves and go to alternate places. Obviously, the alternate places also have to be equally competitive. So there are 7 or 8 industries where Indian sector or Indian corporates have demonstrated the right to win because they have demonstrated that they have the domain expertise, they have the scale for the global demand. They can deliver that kind of scale. And third, they respect the intellectual property rights. Which are these 7 or 8 industries? If you think about it, it's auto and auto ancillaries. It's specialty chemicals. It's pharmaceuticals. When I say pharmaceuticals, it's the contract research and manufacturing and the CDMO space, and of course also some of the generics. Then if you see textiles, you see electronics manufacturing, you see engineering. Within engineering, there's hardcore engineering, power equipment, electronics manufacturing. So there are these 7 or 8 industries where we clearly are on the right path. We are going to become the world's suppliers, okay, or manufacturers, right? With these tariffs, if you see in the first round of tariff, we were much better off because it's all about relative. Whether we may have 150% tariff doesn't matter because US will not be able to produce. They have to outsource from somebody. But if the alternate guy has a much lower tariff than us, then we are pushed to the wall.
So when China was plugged with the tariffs, it was advantage India.
But I'm not even saying China right now. China, they want to de-risk. But if they have a deal with Vietnam, if they have a deal with Thailand, if they have a deal with Cambodia, which are who are competing with us, say for textiles, who are competing with us for some of the auto components, right? We have a challenge, right? So for us, to my mind, this deal is critical, is important. That we all are at the same level. It's a level playing field. It's very important for us with our competing nations to supply to the US markets.
So when you say CDMO space and CMO is going to have a very big competitive advantage, and the moment this entire deal goes through in favor of India and the healthcare center, do you see that the healthcare as CDMO being a better subsector than the hospital or the capex?
See, the hospital is the domestic business. The CRAMS business, the contract research and manufacturing, is all the export-oriented businesses, right? And even today, as we speak, there is no tariff on the pharmaceutical products, right? They have exempted that. So we are right now. It's not nothing. There's nothing to worry. My sense is that the CRAMS business is a mega trend, and it's been there for the last almost now 10, 15 years, but it's accelerating at a different level now because if you see the kind of the capex that some of these large players in this industry are doing, whether it's DV's lab, whether it's Laurus Labs, whether it is even the Cohens, which was earlier Suven Pharma, so all these companies, the capex that they used to do over 5 years has now become their annual capex. So you can, and when they do this kind, and these are contract manufacturing businesses, which means they're manufacturing for a global customer. So unless a global customer is giving them that assurance that we are interested in buying more and more from you, why would these promoters go and do large capex? What I'm trying to tell you is that my sense is that we are in that very, very beautiful sweet spot as far as the contract research and manufacturing, the CDMO space is concerned for at least the next 5 to 10 years. I'm very, very positive on that. Not to say that hospitals will not do well, because hospitals and these are completely different markets. They are serving, the hospital is a domestic market.
But when you compare it as a subsector, what you are trying to say is that CDMO is going to definitely have an edge on as compared to the hospital and the capex sector.
No, I wouldn't say that. I would say they both are servicing completely different segments, different set of customers, and healthcare in India is also very, very underpenetrated, right? So we definitely need many, many, many more hospitals. The only risk that I see there is that, again, there is a very thin line between profit and profiteering, right? I worry sometimes the way the hospitals are declaring their profits. Are they crossing that line? Right? If that happens, then the regulators will be forced to clamp down. They have to ensure there has to be a self-regulatory with the hospitals themselves. They have to show that maturity where they don't cross the line of profit to profiteering. That's my only worry.
Absolutely, point taken. So now would like to shift gears to the financial service sector, which is also very heavyweight with you, HDFC, ICICI. First thing that I see, and I have a very important question for this, is that HDFC sitting there for 10 years in your portfolio, last 5 years, not made any relevant returns. Yeah. So how do you justify that for a span of 5 years? Is what we want to understand, especially for your investors who are there already, and for the newer ones who wants to come in.
Absolutely. This is a very valid question. See, we have to understand one thing, that what investors invest in and what we provide is not stocks and not stock returns. What we provide is portfolio returns, right? So if you see 5 years, I have HDFC Bank, you know that in my portfolio. But for the last 5 years, if my portfolio has beaten the benchmark, which you have the data, right? We've done 23, 24% compounded over the last 5 years.
5 years, yes.
Benchmark at about 18, 20%, right? So in spite of that, something has worked for us. Point number one, right? But more important, to directly answer your question, what I'm trying to tell you is that portfolio construct is also different than stock picking, right? Because we have to understand that at the end of the day, as a fund manager, I am benchmarked to an index, whether it's Nifty 50, Nifty 500, whatever you call it, right? Now, in Nifty 50 and Nifty 500, the HDFC Bank weight will be anywhere between 7% to 10%, right? Now, let me tell you this, that in the last 5 years, I used to own HDFC Bank, but I was significantly underweight. I never owned it more than 5%. It is only in the last 18 months that I doubled my weight from 5% to 10%. And if you would have realized in the last 18 months, HDFC Bank has actually outperformed.
There's a tailwind, yes.
Right? Now, why did I do that? See, as a business quality, it has almost remained the same. No major change except for one big change there. They did a large merger with HDFC Limited.
With HDFC, yes.
Whenever, see, again, that equal that I was talking about, we have some red alerts, right?
So this was a positive merger or a negative merger?
No, it's not about positive or negative. In equal, what we say is, if a promoter holding pledge is more than 70%, we will not invest in that company, right? If a debt equity is more than 2.5 times, we will not, irrespective of everything being great, we will not invest in that company. Why? Because we don't want to take any undue risks for our investors' hard-earned money. We are their trustees. We have a fiduciary responsibility to their hard-earned money. So we don't want to take any undue risks, right? So there is one more parameter which is very important because, I mentioned about in that equal we have 5 things. management integrity, management capability, wealth distribution to minority shareholders. So in wealth distribution to minority shareholders, one is very simple, which is dividend payout. Higher the dividend payout, always better, right? But one very important parameter there again is large acquisitions. We have seen 8 out of 10 times acquisitions haven't played out the way they are anticipated. Okay? So, whenever there's a large acquisition, what is a large acquisition? If it's more than 50% of your balance sheet size, we would avoid investing in those companies for 1 year. After 1 year, we will revisit, we will see is the acquisition playing out in the right fashion. Let me just give you some examples. It's amazing, what history, and this is
Yeah,
very
we
recent.
would love to understand
right?
it from the examples perspective.
Right. So, see, I will give you examples which are the best of the companies in their industry. They're leaders of their industry. Okay. They have the best of the management bandwidth. Financial wherewithalness, absolutely no questions. Right. And yet, when they did some of these large acquisitions, it was a drag on them as an overall company for not 1, 2, 3, but multiple years. You look at Tata Steel Chorus, it's a drag even till date. You look at Tata Motors JLR, it was a drag for first many years. In fact, even today, I don't think they've added any great value, right? If you look at Bharti Airtel going and doing an African acquisition of 11, $12 billion, and how much was it a drag for how many years? Just check that data, right? You look at Sun Pharma buying Ranbaxy. And I've given you names specifically different industries and leaders of each of them. And you see how history is teaching us. You know what I'm trying to tell you. On the other side, there's a company called, say, Tech Mahindra, which bought Satyam. After 1 year, we said, oh, this is going probably in the right direction. And we invested after that. Again, investing is a game of probability. Keep on reducing your probability of going, keep on reducing of going wrong, right? So we said now even if we buy, even if the stock price is a little higher, but even after that, from that point in time, it made tons of money for us. So what I'm trying to tell you is the big challenge with HDFC and bank that it had in the last 5 years was this merger. 18 months back, we realized that this merger, whatever was there, it's all behind us. It's now got digested.
Now it's playing out well.
It will play out because these are fantastic institutions. The DNAs of these institutions don't change. And anyways, they were both from the same mother, right? So that was not a challenge. There was no cultural misfit like probably Sun Pharma and Ranbaxy, right? Or maybe Bharti Airtel doing an African acquisition. They're completely different animals together, I would say. Here, they were actually the same family, but still they had tremendous challenges for the first 12 to 18 months. As soon as we realized that the world, as far as it's got digested well, we said now probably the stock price, which is an art in terms of valuing those businesses because once you identify businesses which are good quality, both management and business, the last thing but most important thing is getting them at the right valuation. Because if you buy something very expensive, it's a great fragrance value, but it doesn't make returns for you. So you have to buy them at reasonable valuations. About 18 months back, we realized that valuation, the risk-adjusted return is too much in our favor. We actually have now made 10% as our weight for HDFC Bank.
So you're very bullish on the banking sector, but not at the PSUs. So is there something that you have against PSUs, or you really love the private sector?
See, actually, as an investor, it's very important for us to be very objective. We cannot have any prejudices. We should not have any prejudices. We should. It's also important that we don't look too much back. Because as we say, in driving, it's all about looking in the front. Because if you look too much in the rear view, you will actually have an accident. And I think the best thing is to say is what is relevant is only future, right? So I think from that perspective, we have to be very objective. Even if I have a prejudice, I need to get that out of my evaluation for any particular whether it's PSU or any other promoter with some background in the past and all of that. But the biggest challenge with PSUs, to my mind, is that I mean, this is historical. Hopefully, probably it may change because we are seeing a lot of positive developments there, right? So, say for example, the way a Japanese bank has been given a good amount of management or a stake in the Yes Bank, right? Which is a very positive development. The way RBL Bank now, of course, that's a private sector bank, but now RBL Bank has also got a large foreign bank taking a very large stake. So these are not things which were very common till some time back. In fact, as recent as now. What I'm trying to tell you is that uh, the challenge so far with PSUs has been we are never sure about whether our interest as minority shareholders is aligned with the majority shareholder, right? The majority shareholder in this case is government, right? And I'm not saying that this may not change. This may change, we will change. But if you see 10 years back, 15 years back, 20 years back, the governments have actually, their agenda with some of these large PSU companies has was not exactly in line with in the or not exactly in the interest of the minority shareholders' interest.
But I believe that this has changed over the last decade, 2014 onwards. The kind of uh, the light that the PSUs see now, the other undertakings, is totally different, and it's not hitting the shareholders at all.
See, I would agree and disagree both. That's why I was continuously saying that as and when it's going to change, we are very open to looking at it, right? But see, if you say 2014, and if you see from 2014 till almost 2017-18, you must go and see how oil PSU companies, oil and gas PSU companies, because we used to own CPSE ETF, which has all the Maharatnas and Navaratnas. Okay, I think 10 businesses there. You should just see their business. Forget the CPSE ETF price, which has not done well anyways. But that's a reflection of how the businesses have done. You should see how some of these oil and gas public sector subsidies were actually getting. There was a lot of challenges there, but it's getting better and better as we are seeing. But as I said earlier, not only PSUs, but even if it's a private sector business, uh, we are very patient. So we track those businesses not only for 1, 2, 3 years, sometimes for 10 years. Like a recent addition that we made in our portfolio was Zydus Wellness. We've been tracking that business for more than 10 years now. We got an opportunity just about 6 or 9 months back. So what I'm trying to tell you is that we want to see that these are not just short term changes. This is a change in the DNA. That's the most important thing.
Yes, point taken. So I want you to come back to 2025 and this new age companies. How are they playing out? So you've got Eternal in your portfolio. How do you see them playing out when we talk about Eternal, Swiggy, we talk about Paytm? Uh, do they have a lot of steam left, or do you see that they are kind of stagnating at one place?
See, let me tell you why did we first, even think of investing in these businesses, right? So, like, most important thing is that the consumers have embraced these businesses. Consumers have not only accepted, but they have actually embraced this business. So consumers are queuing up at these businesses, right? Today, whether it is Zomato, whether it is Blinkit, whether it is Instamart, whether it is delivery, whether it is Paytm, whether it is Nika, I think it's becoming part of our daily lifestyles,
Yes.
right? And not only urban, it's also rural, right? For example, I was just reading, and I think this data has been there for a while now, but it's accelerating even more. In this Diwali season, 70% of the e-commerce orders were from tier 2 and tier 3 cities. 70%. That's a very large number to my mind, right? What I'm trying to tell you is that it's becoming a daily, I mean, the consumers are truly queuing up with these businesses. So the most fundamental question that comes as to us, that you always look at P&L, cash flow, balance sheet. Zomato is actually a loss-making business. How can you invest in what is the rationale of investing in this business, and those kind of things, right? And where is the management quality, and all of those kind of questions. But I always tell my team that, you know, we have to be relevant, and our portfolios have to remain relevant with times. And if the consumer has not only, not only liked but embraced this businesses, we have no business to say that we will not evaluate these businesses. We have to evaluate whether we invest or not. That's an outcome, but we have to evaluate these businesses. And when we were actually evaluating some of these businesses, we realized that they have this inherent profitability. What you say, they have a very strong value proposition for all the players in the ecosystem. Okay. So, for example, if you just take Zomato as an example, because we've been owning this business for 3 years now. Now, when we invested, it was only a food delivery business. Blinkit is probably less than a 18-month phenomena now, right? Which is the quick commerce business. But if you just think of, and both have different value propositions, and we have very strong value propositions. You just think from a food delivery business, who are the 3 or 4, I would say, the parties in that business. So one is the end consumer like you and me who keeps on ordering food there. Second is obviously the restaurant guy. And third is the logistics player, which is Zomato themselves or the Swiggy themselves, right? Now think about it, the kind of the value proposition that they have to me as an end consumer and to the restaurant guy, right? To me as an end consumer, I think that value proposition is phenomenal. For what price? Even if actual delivery cost is only 50 rupees. Right now, they are not even charging you, they're subsidizing and all of that. But even if they charge you that 50 rupees, I mean, in today's day and age, for you to reach that restaurant will cost you much more. Forget about your time, effort, and whether you can reach also or not.
Yes, fair
Right?
enough. Yes.
And plus, you can have multi cuisines 24/7. And in your
And the
in your
works,
in your
yeah.
office, you're working, you can order for your kid can order for you. I mean, I don't know what permutation combinations just keeps on happening, right? So it's a fantastic value proposition. You can't even think about it.
And when we talk about these kids who are just growing up, they cannot envisage a world without a Swiggy or a Zomato.
Yeah, it's become part of our lifestyle, right?
It's a
That's my
lifestyle,
point,
yeah.
right? So, but that lifestyle is also a function of the value proposition that they're delivering it to you, right? So, like for example, I keep on telling my team, when Uber started in Mumbai, I know distinctly about Mumbai. They used to charge you 10 rupees a kilometer, right? And those Kalipili taxis had 20 rupees a kilometer. But the value proposition that Uber did was door-to-door service. They give you an AC car. Kalipili, you had to look for them. They were dirty, they were filthy. There was no AC. Mumbai is anyway it's a warm city, so it's difficult. So we all got used to Uber. Today, Kalipilis, they ensured that Kalipilis have vanished. And today, Uber charges you nothing less than 35 to 40 rupees a kilometer. Nobody's even blinking an eye because it's a great value proposition. You've got habituated to it and you don't even have an alternative now. Right? Similarly, for the Swiggies and the Zomatos. So that value proposition is great. Now, think from a restaurant guy. Now, from a restaurant guy, when we invested was a lot. I mean, today, there's a lot of noise from restaurants that the Zomatos and Swiggies are actually, they're looting us because they're charging 20-25% from us. Think from their perspective now. Because I said at the end of the day, they are businessmen, right? For any food or a restaurant business, the raw material cost, the actual food cost will never be more than 25 to 35%, which means they are at a gross margin of anywhere between 65 to 75%. Now, for the business that they are getting through Swiggy and Zomato, I think 80% of that business would have never reached them. Only 20% people would have been able to reach to that place. For that 80% of the business, if they have to give away 25% also out of that balance 65%, it is still 40%.
It's a deal, yeah.
40% on an incremental revenue where you have no additional cost. I mean, which businessman will let that go? Come on. Right? So what I'm trying to tell you is that we could see this inherent profitability in the business. It's just a question of they investing at some point in time to to give you that feel and experience of that value proposition. And once you have that value proposition inbuilt, ingrained in you, they are going to charge you. And you will have no complaints with that.
And I believe that India has this consumption story, and India is going to drive it well because we have this huge amount of the younger class, the working class,
See,
who's earning and who would love to spend on
exactly.
themselves.
See, what is our key strength? Our demographic dividend that we all talk about. What is it? Two things to my mind, and it's a lethal combination: young, aspirational.
Aspirational, and also they are the earning members, so they would love to spend the way
Because
they
you are
like it.
aspirational, you are forced to earn. You know what is driving you to earn.
So
See, when
this-
in the rural villages, they had not seen a car. Then the television went there. That's when they saw Hero bike. The aspirations,
started to grow up.
right? Today they are buying Nika because it's there on their mobile. So the aspirations is going. See, they will take all the stress. They will get all the blood pressure and the sugar and diabetes.
To make sure that they're able to achieve
Yes,
that.
yes. So it's the young aspirational.
So that
lethal
gets me to the
combination.
next question, and that is that 2020 to 2024, we have seen a bull run, especially after the COVID, and that was capex driven. Okay, everything was surrounding around capex. The government was supporting the system of capex. Now, 2025. What do you see? Do you see consumption as a driving factor for this bull run that is coming in, or do you see something else coming in?
No, I personally feel that both capex and consumption are going to do fantastic, right? Because consumption had some serious slowdown over the last 12 to 18 months, and clearly inflation and all of that had started hitting. But I think in the last 8 months, okay, there have been so many positive developments, positive interventions by the government, regulators, and I would say also thanks to nature, right? So it started in February with the budget interest rate relief, income tax relief. Then we had liquidity relief. Then we had interest rate cuts. Then we had
GST cuts.
fantastic monsoons. And now we have, I think GST is an ultimate bumper bonanza. Right? It is really going to set us into that virtuous cycle for the next, at least to my mind, 3, 6, 8, 10, 12 quarters to my mind. Okay. So that virtuous cycle that we are getting into now will definitely drive consumption big time. But consumption will then obviously, because most of the industries are already running at 75, 80, 85% utilization. So a little bit of extra consumption or demand on the domestic side, you will need capex. You need to create capacities. But even more, as I said, I see these two mega trends. First mega trend is in terms of the domestic consumption because of the young aspirational population. And second mega trend is in terms of this China plus one, Europe plus one outsourcing. These 7, 8 industries will drive tremendous amount of capex.
So, while we're reaching towards the end of this podcast, so I want to have a prediction that is coming from you about 2026, 2027. How is the India story going to play out? And what is it that the investors, short term, long term, doesn't matter, but what is it that the investors should be excited about?
See, I personally believe that we are in a really sweet spot. Okay, because as I said, all these interventions that have happened are actually going to play out very beautifully.
So
That's
that means
point
the
one.
India story is intact.
No, it's not only intact; it's getting better.
It's getting better by
It's
the
getting
day.
better because now you have valuations becoming reasonable. That is the best part. Like today, like when we talk about HDFC Bank, like I was saying that all these high quality companies are not easily generally available at good valuations. But today, if you look at HDFC Bank, ICICI Bank, or some of these large private sector banks, even if you see some of the like auto companies before this GST cuts, were all at very reasonable valuations. So you are getting a very good amount of, quality companies at reasonable valuations, and the earnings growth cycle is picking up. So what more do you ask for?
So that's very bullish about Sachin as the fund manager for
Sure.
the MK Capital Builder Fund. and that's very exciting to see that you are all bullish about it, and you're so positive about the India story. So we've talked about your stay in a particular sector or a particular company for a very long time. Uh, that is getting your churn rate very low, which is also very good for the investor because his tax liabilities are reduced and it's very efficient taxations for him. Uh, I want to understand, what is your exit strategy?
Sure.
How do you finally come to a decision that now this is the time I should be exiting a HDFC or a ICICI or a Mahindra Resorts or Divis or anything else that is there?
Sure. See, the way we think about it is there are two or three reasons why we would exit. Any one of them coming around, and we will have to exit, right? And that is the privilege that we have as minority shareholders and as investors in listed equities. So there is liquidity, and we are not owners of the business. So we have the option of moving our loyalties, right? So the way we think about it is that either first, the business is not going in the right direction. There's a structural challenge, not a cyclical challenge. Because as I said, every business will go through a good and a bad cycle. We don't get perturbed with that. But if we believe there's a structural challenge with the business, right, then obviously we have to take a hard call. Or if we believe there's a franchisee issue, if the business franchise is weakening for whatever reason, because of competitive landscape, because of some disruption, there can be many reasons for that, right? So then we would definitely take, like for example, US generics pharmaceutical market. We used to own businesses in 2014, 15, 16 when it was US pharma generics businesses were doing very well, right? We exited those businesses because we realized that the valuations have now run up too much ahead of time. So that's the third condition when we actually exit. But after some time, when the stock prices came down, valuations became reasonable. But we did not invest even till date. For almost 7-8 years, we've avoided investing in US, basically pharma companies which are into US generics market. The reason is that we saw there's a structural change over there. And what is the change in structure? That market became concentrated in the hands of only three players. And those three players had the entire pricing power. So they squeezed out the entire profit margin. And the supplier here was extremely fragmented. Right? All these all these generic manufacturers had no moat as per se. So if somebody was selling a paracetamol, the other guy selling the same paracetamol. So that guy just kept on, and you have only 2 or 3 buyers now for the entire large US market. So you had no, bargaining power. The bargaining power of the manufacturers in India or even in some of the other countries, emerging countries, to supply to US diluted big time since 2016 and even today. So this is a structural change. So we will, as soon as something like that happens, we avoid. Okay. Or business has not gone in the right direction. Our judgments have gone wrong. We realize our mistakes. We definitely accept that mistakes and we exit. Or third, which is actually a little difficult thing to do, but whenever stock prices would have run up too much ahead of time. So, and how much ahead of time is always a question. But I just was reading an interesting book and where it gave me a nice formula where it said that if you believe that it is discounting at least next 3 years of earnings, and after 3 years also you think that even if the earnings play out the way you are anticipating, you may not be able to make any returns, then it's easy to exit. Or the other thing that we internally benchmark is that if my return expectation from this particular stock is now not or is as low as a fixed income, then why should I take an equity risk? I rather move that money from an equity to just fixed income with almost no risk.
So I believe that was a very insightful talk with you, Sachin. Thank you so much for sharing your insights as to how you look at markets. And I'm sure that all our viewers for Returns and Beyond at Wealth One will benefit from this entire thing. So for the viewers, thank you so much for watching this show. And I believe that keep invested, keep learning, and keep educating yourself to however the markets are moving, and you will always be there as compounding if you have the conviction. And that is what Sachin says. Thank you so much, Sachin, for joining us this show, and would like to conclude this with a big thank you to you.
Thank you, Naren. Always a pleasure. Thanks a lot.
Thank you so much. Thank you. So, we've had a wonderful podcast, but would like to say that a small disclaimer that all the things that we have said is for educational purposes, and the viewers, the investors, are requested and instructed to please take your own decisions while you're investing.